Welcome to this video on how global central banks react to higher inflation. The US Federal Reserve will probably completely stop its bond purchases by the middle of next year. It has no other choice as labor cost growth is picking up. The quite reliable employment cost index rose by 3.7% year-on-year in the third quarter. Canada's central bank already decided last week to end its bond purchases. It also held out the prospect of an earlier interest rate hike. And the Australian central bank decided earlier this week to abandon its yield target for 3-year government bonds. The ECB is doing everything it can to set itself apart from the other central banks. In particular, it points to the fact that unlike in the US, wages in the euro area are barely rising. In this way, the ECB is arguing against investors who are expecting the first ECB interest rate hike already at the end of next year. I think such an early rate hike is very unlikely. Instead, the ECB is likely to buy more bonds under the APP program after the PEP bond buying program ends in March. So the ECB will decouple itself from the Anglo-Saxon central banks, also because it wants to support the highly indebted Italy, which is refusing far-reaching reforms and instead pushing for a loose monetary policy. The first ECB rate hike will come later than the markets expect.